Kitco News special coverage of Messari's annual Mainnet Summit is brought to you by Oasis Pro.
So you're thinking about investing in crypto, but you're not sure how best to do so, or how much to allocate, or even where or which coin to buy or which platform to use. I'm Matt Nesto with Kitco News. That's a quandary that countless investors, both large and small, are currently facing at the moment, and one my next guest is very familiar with as his company gets set to launch its first investment fund next month. It happens to be pegged to Ether. He's Jason Hall. He is the co-founder and CEO of Methodic Capital Management. Jason, thanks for coming on Kitco. Appreciate it.
Very much appreciate your time. Thanks for having me.
Let's talk about this quandary. You know, there's a lot of press and publicity about the Bitcoin ETFs and, you know, maybe pent up demand and how that's going to go. But your first fund is focusing instead on the Ether. Tell me about, you know, the climate out there and sort of the nuance between the different funds and why you're coming to market next month with that one.
For sure. It's a challenging landscape for sure. There are a lot of investment options that are coming online as we speak. ETFs, ETPs, there's other funds. From our perspective, when we look at something like ETH, which is a proof of stake chain, we look at the total return of ETH. So we're looking at the price return and we're looking at the reward rate. And we believe that any investor that's coming into this space should be looking at that total return and how do I capture that total return. So when you look at the reward rate, it's going to fluctuate somewhere right now between 4 and 5%. That's a lot to leave on the table if you're buying something that is, you know, giving you price return and not total return. So when we think about building a fund and building a product, we look at compliance, we look at the total return that we're giving and how we're getting it, and we look at the transparency. Are we delivering that to investors in a way that gives them confidence?
So, you know, let's just take there's an asset manager. They got their clients, they're getting calls. Hey, are we doing anything? I keep reading about Bitcoin. I keep reading about Ether. I keep reading about, you know, whatever it is. And they want a blockchain. They want to get involved. They're not sure how to do so. And then you guys come and, you know, offer a solution to their problem. What is that conversation like? How do they actually need to be brought into the tent, so to speak?
I think it depends a little bit on who you're talking to, but I think the broad brush is that anybody that's not in the space, that's considering coming in, is doing so with a high degree of trepidation. There is some skepticism, perhaps. There's some fear around the technical risk, the compliance and regulatory risk, the reputation risk. Who am I invested in with? Who's managing my money? What are they going to do with it? You know, what's the headline tomorrow? That, you know, these are the kinds of things that people are thinking about. So when you sit down and have that conversation, you can talk about price return, you can talk about reward rates, but the first thing you need to talk about is, are we doing this compliantly? Are we compliant today, and are we forward-looking compliant? Are we doing it with a degree of transparency and an ethical bar that is going to allow a high net worth individual or an institutional investor to have confidence to dip a toe? And that's really where crypto has done itself no favors with a lot of the traditional investor set that is interested in the space, interested in the technology, possibly even believers in the technology, but really need to consider their fiduciary responsibility or just the responsibility they have to themselves for their own, you know, family's net worth. And that's where we come in and really try to have a conversation that starts on what's the bedrock that this thing is built on, and how are we going to deliver this to you? And then we can talk about the technology and the returns a little bit later.
One of the things I read about Methodic was that you're looking to provide a fully compliant and safe conduit for new capital to enter crypto. So like you talk about, there's already people investing. It's not a new idea per se. But there's a lot of investors, maybe we shouldn't be investing, that are in, but this is new capital. You think there's really, give me the sense of the pent up demand that's looking for an in, that's nervous, that, you know, needs to, you know, finally drop that first ticket and see how it goes. Probably small to start.
That's right. It's a, it depends on, whether you're talking about a person possibly who's holding a little bit of crypto. Maybe it's not staked. So this is the analogy that's been used. You got to be a little bit careful with it because there's a regulatory sort of implication, but it's a little bit like I'm holding stocks, I'm holding equities, and I'm foregoing the dividend payment. So I'm holding ETH, it's not staked, I'm not earning the reward. And so, there's a relatively large pool of capital that maybe 2 or 3 years ago, maybe a year ago, have come in with a small allocation to the space. And now, maybe due to regulatory concerns, maybe due to some of the difficulty with centralized platforms and some of the challenges that they've run into running their businesses, now they're sort of unsure where to go inside the space. Then you have the folks that are interested but are sitting on the outside. And that is a gigantic pool of capital, but to your point, the allocations are going to be very small up front. So it's really, I think, not just incumbent upon us at Methodic to build a trust layer for those folks to come in and write that first ticket, but it's also incumbent on the entire space as well to rebuild the trust factor too. So, we're talking about crypto, you have to bear in mind, is a very, very small asset class relative to traditional assets. So it doesn't take much to move the needle, but you've got to have the trust first.
I mean, we've talked about staking. We're kind of beating around the bush here without blowing up my mind here and getting too crazy. How do you explain staking and the importance of it? You've used the dividend analogy that, no stock investor would just be like, you keep those dividends.
Yeah, right.
So help us out on staking, the staking economy, and even the name of the fund, is the Methodic CoinDesk ETH staking fund. You're not hiding that fact. How do you describe it?
Yeah. So a proof of stake blockchain operates by having computers on the blockchain validate transactions. It's done in a decentralized manner rather than a centralized manner. And so there are many of these computers running validator nodes, basically hashing transactions. It's a little bit like, I've described it in the past somewhat successfully as a whole bunch of bookkeepers going through and clearing the general ledger. And so to incentivize users to perform this task, the network itself pays a reward rate in ETH, which is important, back to that node operator. So the ETH, where does it come from? It's generated by the network. So that is increasing the supply of ETH and paying it to these node operators. The reward itself comes from two places. One is from validating blocks or transactions, and the other is from the transaction fees that are paid. So a user of Ethereum comes on, they make a transaction, they pay it what's called a gas fee, they pay it in ETH, that gets distributed back to the node operators. So it's a service that's used to operate the blockchain and secure the blockchain. And it generates it's not a cash flow, but it could be thought of by a traditional investor as a cash flow back to that node operator. There's a technological burden, obviously, to being able to do that, which is where a lot of staking service providers is where we come in to kind of take that operational burden. But in effect, what you're doing is using your ETH to run one of these validator nodes. So how it actually works, the term staking is when you take a block of 32 ETH and you lock it away in a smart contract, and it is used as a form of collateral to make sure that the node operator is performing with good intent. If you do something against the network, you try to do a malicious transaction, or you try to do something that is nefarious, you can get what's called slashed, which basically means you get fined. So a portion of your 32 ETH would be taken as a form of penalty for doing that. So the staking is what you're talking about. You're putting that 32 ETH into that smart contract as collateral. By the way, that happens very infrequently, very infrequently.
Talking about regulators, what do they think about staking?
Well, there's been a lot of talk about it, for sure. And that talk comes in two forms. There's talk about staking and this idea of generating rewards through staking. And there's this idea of running those nodes. And is it a technology service or is it an investment activity? The regulators have not ruled one way or the other yet, but there's a lot of chatter around, okay, Gensler has categorized staking as lending rebranded, which I take serious objection to, but that gives you a sense as to how the regulators are regarding staking. They've also suggested that perhaps a technology service provider that's running a validator node is actually providing an investment service. The implication for that is great, because if it were ever decided that were true, a lot of staking providers would suddenly find themselves as an unregulated investment advisor as opposed to a technology service provider.
I think the late great philosopher Jerry Garcia once said that the lesser of two evils is still an evil. So in your universe right now, for when you're trying to attract new money, what is the lesser evil, if you will? Is it economic risk, macroeconomic risk, or is it regulatory risk and the sort of unseemly characters that screw up and find themselves in the news? Like, what is the big risk out there, and not necessarily in your eyes, but in the eyes of the people that you're trying to get into this investment?
It's a good question. I think for starters, I could say, and we could talk about this, I think that Methodic offers a solution to two of the three risks that you just listed. But I think in the eyes of investors, especially institutions, the allocation that they're making is relatively small. And these are professional investors. They understand that when they're buying a high volatility asset, and they're prepared for that volatility. What they're not prepared for and not willing to take on is those latter risks that you mentioned, which is, I'll lose my money to volatility. I do not want to lose it to a hack. I don't want it to get stolen. And I don't want the compliance or regulatory risk, because there's a contagion there, potentially. It depends on the organization. You don't want that contagion.
You mentioned professional investors. I was reading a LinkedIn post you guys put up recently. It says, quote, "We're encouraged to see more professional advisors entering the digital asset space. With them comes a heightened level of professionalism to assuage some of the stigma in DeFi that's preventing new capital from entering the market." And so that is obviously a positive, but it's sort of a nascent trend, I would gather.
I think that's right. And a lot of early DeFi was built on what maybe ended up to be presumptions that because it was technologically based, they could operate what ended up being financial institutions in an unregulated manner. What a private fund does, so we launch in private funds. What a private fund does is give you a layer of regulatory insulation. Because if we go back to this idea of, is staking or offering staking a technology service or is it an investment activity? If it's inside of one of our private funds, it is impactful to the industry. We are agnostic. If you call it an investment activity, well, we're investment advisors, and so we're happy to operate under that, under that ruling. Same thing with, is it a security? Is it not a security? Great implications to the space. From an operational perspective for our funds, we're insulated from that. So you're seeing, I think, more people realize that and come into the space. And you're seeing, I think, there is an opportunity here to create value by bringing professionalism into the space. And so you're starting to see that.
When I think of professional investors, I always think of the little pie chart, the allocation chart, right? And it changes for everyone. They have their different things. Do you see the day when the digital asset is going to be always part of that pie? Is that sort of like when you've arrived, basically? When you have to explain, like, it's not there. Like, if you ever put an allocation pie out there and it didn't have stocks, bonds, and cash in it, people be like, well, what's going on here? Right. Does that day come? And how so? If so, how so?
That day comes, I believe, certainly. I think you're right. And by the way, figuring out where in the pie chart it goes, not so easy.
Well, it just depends on a million things.
It depends on a million things, right? You could call it a fixed income product if you're looking at the reward rate. You could call it a tech equity or growth equity if you're looking at simply the price action. You could put it in its own bucket if you were so inclined. But how do we get there? Ultimately, crypto will live or die based on adoption. And adoption means real use cases, not speculation. And so what needs to happen is all the builders that you see in a conference like this and all of these organizations need to, if they haven't already, start reorienting themselves to the outside world. Crypto's become very insular, and that insular nature has prevented a lot of adoption from mainstream companies. Once you start to see the flywheel effect, where companies start to realize the efficiency gains, the cost savings, et cetera, moving onto the blockchain, you're going to see adoption explode, and how you operate on a blockchain, how you pay for the transactions is with the native token. So now you have a demand spike from that adoption. And if you take the case of ETH or Ether, that is a deflationary supply. And so now you have a declining supply, you have an increasing demand, and you have a huge spike. And so I think when you start to see that, you're going to see people really starting to allocate.
Hopefully the only thing that explodes is the demand, because I mean, truly, I guess to launch any product, it strikes me that there's a few things that need to happen, like good performance. Nothing sells like that.
That's right.
A track record, which also kind of dovetails into the need for benchmarking. Like how do I, what can I consistently compare to?
Yes.
And so where are we on those fronts? But performance you can't create. You can back test, but
I agree. Back test is not worth a whole
what
lot.
it is.
Yep, it is what it is.
Asterisk.
Yeah, asterisk. That's right. So good news on the benchmarking front. There's a lot of groups that are working on bringing out professionally managed indices. We happen to be partnered with CoinDesk Indices and CoinFund. Chris Perkins, who's the president of CoinFund, is a great champion of ours and a friend of our organization. And he has created Caesar, which is the composite ETH staking rate. This is the rate that is basically the gold standard of what a ETH staker should be earning in rewards. And so that rate serves a number of different functions. One is it is an accountability mechanism for us. We have effectively tied ourselves to the performance of Caesar, and you're going to be able to know pretty quickly how good of a job we're doing based on how our returns look relative to Caesar. Caesar is also a burgeoning reference rate. So if you look at LIBOR minus the controversy, or you look at SOFR, these are reference rates that have massive derivative markets built on them. The introduction of these reference rates into crypto is a sign of maturation. It's a sign of, being able to build a functioning derivatives market, which, and you get into the really large investors or the really large commercial users, that derivative market becomes critical because that's how they hedge. And so the benchmarking is nascent, but there's really been a lot of recent strides that we're pretty excited about.
I like Caesar. It's catchy.
It is
That's
catchy.
a start. I don't know how it ended for Caesar, but we don't need to get into that. Is there anything we overlooked here today that you feel is pertinent? We're sitting in this room full of all these developers. They all get it. They're all kind of here, but out there, that's kind of really where it is ultimately somebody's got to sell this thing, and that involves hand holding, and that involves regulators. It involves limiting bad things that happen that are going to happen in a budding industry.
Yep, I think unfortunately crypto has had a series of messianic, megalomaniacal personalities that have come through and sort of prophesizing crypto and fomenting a real us versus them mentality. It's traditional finance, it's decentralized finance. And those people, unfortunately, especially early on, were the Pied Pipers for a lot of retail investors who marched to their doom, unfortunately. That has brought, rightly so, a great deal of scrutiny from the regulators, whose mandate it is to protect investors. So they're going to look very closely. Then we have SBF, Sam Bankman-Fried with FTX explosion, that really hit the institutions. And so there's a pall a little bit over the space. Those are the headlines that non-crypto people read. They don't look into the projects that are being built. They don't see the efficiencies that are being created. They see the headlines, and rightly so. So I think one of the things that we're starting to, wrestle with in crypto, which is a little counter to its ethos, is that the who's matter. The people matter that are on the other side of this. Crypto has largely been anonymous. It's been, as people would say, you're remaining undoxed, which basically means your identity is not publicly known. There's a great deal of emphasis put on privacy. These are great things. I mean, privacy is a hot button issue right now, and crypto and decentralized finance offers a lot of solutions. But unfortunately, I think a lot of people have used that sort of philosophy to personal gain. And we're now starting to come around and saying, okay, it's time to kind of come out of the shadows a little bit, identify who's actually in these projects, who's working on these things, and make sure that they're ethical and working toward the right thing. So, if we can do that, and we can bridge the sort of walled garden between crypto and the outside world and solve real business problems, I think you're going to see ushering in not just an entirely new asset class, but an entirely new infrastructure on which businesses, not just financial services businesses, but industrial businesses and what have you, can be built on.
Cool. Jason Hall, thank you so much. Appreciate it. Good luck with the new fund. I hope it goes well for you guys. We'll have to have you back. And, good, bad, or indifferent, just bring us up to date just in terms of what the uptake is in the market.
We certainly will. Look forward to talking to you again.
Co-founder, CEO of Methodic Capital Management. For Kitco News here at Mainnet, I'm Matt Nesto.
Kitco News special coverage of Messari's annual Mainnet Summit is brought to you by Oasis Pro,